Hey traders, Chris from Mullen from thetechnicaltraders.com. Want to show you, I just kind of recap quickly on the SPY or the SP 500 index, some short-term price action, some ways to get a feel for when this market's overbought, oversold, and how to measure upside targets for short-term momentum traders when the market gets oversold. So this chart here is showing us our trend analysis. When the bars are red or orange, we're neutral or in a downtrend. Obviously, this is a reversal where the market's ripping to the upside, changes trend here, and green bars mean we are in an uptrend. So this whole pattern here, if you look on this daily chart, you can see how they're linked together. It's the same chart, just the one on the right is the daily, and this one over here is the 30-minute regular trading hours only. So let's take a look and zoom in on this chart more or less. We'll just scroll in here to the more recent price action, or we can actually just full screen it here and zoom right in. Now what we're looking at is simply the market when it becomes oversold. We get these lime green areas, which is telling us, hey, this market's starting to sell off. Typically when we get an oversold level that's lime green and we see panic selling on the New York Stock Exchange, when we see both of those, that's usually a sign that, hey, this market is most likely putting in a short-term bottom. Now, this pink line here is the 20-day moving average. I find it a very critical level where the market typically likes to find support. And I talk about it all the time. The next one shorter is the 5-day moving average. On the daily chart, it will act as a very good support level. So here we've got a couple levels. Here's another panic selling level. Once we get above this blue line, that is a panic selling level. We had another one here, and we had another one just last week, causing the market to sell off. Now, over here we got oversold. We didn't get panic selling, but still got oversold, came down to the 20-day moving average, but really strong opportunities here in this market. Now, we'll keep in mind now, when we break this blue line, this is when we're into a short-term kind of panic in the market where people put in a short-term low. Typically, we see a 1+% move very quickly, or at least 0.75%. Within a day or two. These are very strong momentum pivot lows in the market. And I'm going to walk through those charts in just a minute. But if we zoom back in time a little bit and you go and you look at panic selling in this market, you can see when the trend changes and the big money really starts to dump out their shares to get out of that, it creates this massive flood of selling. Eventually we see the fear, the selling volume start to dissipate while the price is going down. So there's fewer shares being sold as we get to the bottom, and that's actually a divergent sign. But when we see this panic volume ratio above 8 on the chart, that is usually a sign that within 2 to 3 days, we're going to see a very significant standout low on the chart, like a swing trading position type of low, which is what we ended up getting, a very strong cycle low in the market. It cleanses things, and then we go into this uptrend. So there's a couple different ways to read our panic selling volume indicator here, but let's just look at this price action and let's focus more so on Fibonacci extensions on how to measure where these next moves are going to go. So I'm just going to zoom in a little bit here. If I grab a Fibonacci tool, if you don't know much about Fibonacci extensions, very powerful. I use it all the time. More or less, you take the low from where our rally started, from a significant low, and you go to the recent rally, and then you come all the way back to the deepest pullback there and carry that forward. And that's going to tell you where this upward price, where price should go. You get the rally, you get the pullback, then you've got your first 618, and then you've got your 100% measured move, which happens to be a previous high here. So if you get into this, this is kind of when you do have this pullback, you can measure where the upside move is before it's most likely going to run out of some steam, which it did. It went a little bit higher and then crashed out again. Now, if we took Fibonacci extension from the next pivot low here, we go back up to this high. We're going to forget this. This is just a spike, random tick. We go to this high. We come back to this low. We carry that forward. You can see price ended up rallying all the way up to 100% measured move. And eventually it kind of spiked above it, and then it crashed out again. So if we move forward here, we can grab the Fibonacci extension. We had this low a few days ago. You get this first impulse move to the upside. Depending where you want to rally, this is where I'd probably be looking at it as very conservative play. This is kind of where that upside move, you get the first move, the pullback, and then the second move brings us up, close to these highs. Now, obviously, this kept on going and kept going even higher. And of course, you can extend these moves each time. So, for example, if we rallied all the way up here and had this huge, we made a new high, and then we had this pullback. Well, we could take it from the most recent level here, where this new rally started, to the top and down to this recent pullback, and carry that forward to where price should go. So based on this rally and this pullback, that is right where the market ended up going. So you can use Fibonacci to constantly be measuring where these short-term resistance tops are, where the market could run out of steam. And of course, we've gone back into a panic selling phase. So what we're looking for more or less this week is, where is this market going to go? Are we going to have a rally up and some type of pullback, at which point we can draw our Fibonacci targets to the high and then find where the low is, and then we could see where the next potential upside is. But first we need this impulse wave to the upside, and then we need that pause or pullback, and that's going to tell us where this market is headed next. So overall, we are really close to the stock market potentially having a little bit deeper of a correction. If we actually go and take a look at the chart of bonds, I'm going to look more so at the daily chart here. The bonds market got very oversold. It's had a knee-jerk reaction to the upside. I feel as though it is about to start to firm up a little bit. We're going to keep our eyes on the trend analysis, but you can see here there's a series of lower highs, each one of these, and then we had a really strong short-term impulse wave. Impulse wave is a knee-jerk reaction back to the upside, and typically if you can break two previous pivot highs, which we did, we broke 1, 2, 3 previous highs, the market rallied above them, and then you get that pullback, it's going to give us an upside potential shift in direction. So we go from the low to the high down to this low, and it's saying that bonds could end up moving from where they are now up into this area. And it's only 1%, 1.3% move. Again, this is short-term analysis on the 30-minute chart, but it's going to bring us up to this 20-day moving average, this pink line on the 30-minute chart, which is also the pink line on the daily chart over here. So that would bring us up into that zone, which kind of brings us close to these pivot lows in the market. So that's kind of what we're looking at. Utilities as well. Let's look at the XLU. It's actually showing signs that it's trying to carve out a bottom here. You can see it went from green and had these strong rallies to finally a trend shift. It's in a downtrend and now it's showing huge volatility. It's actually making a series of higher highs and higher lows, so that's a good sign. And the trend here analysis has gone neutral, saying, hey, it could be shifting from downtrend to green bars. And when we look at the daily chart, it really does look like it's trying to carve out, what you could say here is kind of a rounding formation, and this is a base. And if it starts to break here, we're going to go probably back up to the 65 level, current at 63 right now. So if that's the case, that means the stock market could have a choppy week this week. These defensive plays, bonds and utilities, could end up actually doing okay, while the rest of the market struggles for a little bit here. So hopefully that gives you some insight on short-term analysis and looking at the daily chart using Fibonacci extensions and trying to, and the 20-day moving average. Very critical line in the sand on the chart, the 20-day going forward. Anyways, that's it for now. That's your trader tip of the day. Take care. Bye-bye.